Hi, this is Morris. So in the last couple of episodes we've talked about firstly spending less than what you earn is the first secret to financial freedom, and the second one is to have a plan, and that is to commit to investing and saving before you commit to your spending. So in this episode, what do we actually do with those savings? And I guess what I want to talk to you about is really no different when people come to me and talk about, well, how do we invest the money that we've got in the bank, or how do we invest our retirement savings when they get closer to retirement. When you invest money, there are really three asset classes: cash, property and shares. It's a little bit more complicated than that because there are different sorts of cash and there are different sorts of property and there are different sorts of shares, but effectively it's cash, property and shares. If you understand how these three asset classes work on their own and how they complement each other, it helps you to make a decision about how you should invest for your money to grow. And I'd like to draw it for you. So if we think about time, we're getting older as we go this way. Here we are today, and we think about money this way, and let's just make up an arbitrary number of $10,000. It doesn't really matter. $10,000, right? The first asset class we talked about was cash. So if I was to draw for you what cash would do over a period of time, I would be drawing simply a steady increasing line. Just slowly goes up, a bit of interest each year, and at the moment interest rates are pretty low, but a bit of interest each year, it'll slowly grow. No magic, no secrets about that. Most people understand how their bank accounts or term deposits work. If I was, however, say to you, let's put $10,000 into Aussie shares, and look, that's not simple to do. There's lots of different ways of doing it, but just in general, when you watch the news at night time and it talks about the All Ordinaries going up or the All Ordinaries going down, they're talking about the average value of all shares on that day, what's happened. If I was to draw that for you, I have no idea what the future is going to hold, by the way, so this is looking in the rear view vision mirror. Just in general, I'd expect to be drawing a line that looks a little bit like this. Lots of ups and downs, a bit like a little boy with a yo-yo walking up a hill. Quite likely, in the early years, that you can actually have less than what you started. And over time, yes, it goes down, you've got less than what you had the year before, but you're a lot better off than what you would have been had you kept the money in cash. If I was to draw property would be somewhere in the middle of this. So again, I'd be drawing, instead of the big ups and downs, longer, loopier lines. You know, property seems to have 4 or 5 year cycles. You have 4 or 5 good years, 4 or 5 bad years, 4 or 5 good years. And still likely that in the early years, you could actually have less than what you started with. In the long term, a very clear pattern emerges, and that is, in general, good quality shares outperform good quality property, and both of those are well above the returns you would expect from cash. In the shorter, and when I say longer term, I'm talking 10 years plus. In the shorter term, what you may find, let's say 10 years, for example, let's say that that's the 10-year mark. Some 10-year time frames, shares are better than property. Other 10-year time frames, property is better than shares, but both of them are still better than cash in general. If you shorten your time period, however, say 5 years, there have been some 5-year periods where you actually haven't been better off investing in shares and property. You might have been better off, but there's also a chance that you may not be better off. And if you shorten it again and look at the next 2 years, well, you're in the lap of the gods. You could be way better off in 2 years' time, or way worse off. So the message in this is, the longer the time between today and the day you're going to need the money, the longer that time frame is, the more you can afford to invest in shares and property, because you've got the time to ride out the volatility and be better off. And the opposite applies. The shorter the time, the less you should have in shares and property, because if you said to me, Morris, with this $10,000, I just want to invest it for my holiday next year, You'd be crazy to invest that in shares. You'd be speculating. You're not investing. If you're investing in shares for a short period of time, you're speculating. Why do shares and property perform better than cash? And that's because they make money in two ways, as opposed to cash. With cash, as you know, you put money in the bank, you get a bit of interest, you get income from the interest, and that's it. You make money in one way. When you invest in property, you get rental from the tenant, and you hope that if you bought a good quality property, that the value of that property over time also goes up, and you've made a capital gain. So you make income on the one hand along the way, and a capital gain as well. Similarly with shares, when you invest in good quality shares, along the way you should get dividends if you've got good quality shares. So a share of the income, you get dividends, and you hope that if you've bought into a good company that the price has also gone up. So you make money in two ways. That's why they perform better than cash. Why are they so volatile? They're volatile because it's all based on supply and demand. So the more buyers you have, good quality companies are going to go up, and if there's good reasons, good economic environment, they'll go up even further. When there's bad news, because you can sell them quite easily on the market, if you have more sellers than buyers, they go down. You get rewarded for that volatility if you hang on to good quality growth assets, and you will get superior returns. So spend less than what you earn. Then have a plan to invest before you spend. Have a plan. Have some goals that you're aiming for. Put money away for goals. Depending on the length of time that you've got before you need the money, think about investing in good quality, income producing growth assets like shares and property. In the short term, cash is king. In the long term, you will make a better return by exposing yourself to good quality shares and property.